Hello, everyone. Welcome to the first 7 market movers of 2026. My name is Gary Quinzel, Vice President of Portfolio Consulting here at Wealth Enhancement. Before we dive into today's market movers, I want to do a quick recap of 2025 because it really was an extraordinary year any way you look at it. Starting first with U.S. equities, it's hard to believe after the start that we had that U.S. equities, as demonstrated by the S&P 500, would gain 18% for the year, which was its third straight year of double-digit returns. This past year, most of the return was actually driven by earnings expansion, so not multiple expansion as it had been in previous years. The same cannot be said if we look overseas at international stocks, which notably outperformed the US. So if we look at the EFA, the MSCI Developed International Index, gained around 31%. The Emerging Markets Index gained around 33.5%. A lot of that was driven by multiple expansions. So investors are feeling better about investing overseas. And of course, the softer dollar to start the year also played a contributing factor. We're starting to notice investors feeling more optimistic about investing overseas. And the big part of that is probably because of the concentration that we are experiencing here in the US with the mega cap tech leaders. If we look around the investment universe, it wasn't just stocks that did very, very well. Bonds did very well too, as we saw interest rates generally come in. We saw the Bloomberg Barclays Ag gain around 7.5%. We saw even munis had a good year after a rough start, gaining around 4.5%. High yield did well. And most notably, gold, if you think about safe haven assets, gained around 65%. A lot of that driven by geopolitical uncertainties. And of course, there's also a lot of central bank purchases of gold. And so we continue to see that ride a wave of popularity. Does feel like it's getting a little overbought, but it's a very hard thing to gauge from a time perspective. So if we take a look at what's happening right now, today's news is really focused on the Supreme Court ruling that's going to rule on whether or not the President Trump's Liberation Day tariffs are legal or not. So all eyes are on that. We could see a ruling as soon as Friday, January 5th. Regardless of the outcome, I think just knowing where we stand is going to be beneficial, removing that layer of uncertainty. But I think more importantly, if we do see some of those tariffs ruled against, if the ruling is against the tariffs, that could definitely benefit certain companies, especially those companies that do a lot of importing. They could certainly improve margins, lower costs to consumers. So if we're looking at sectors like staples, discretionary, industrial, certainly could see a larger impact. And we've noted that almost 1,000 companies have already lined up to potentially sue to recoup some of those losses over billions of dollars that have been levied so far in duties so far. So we'll certainly be paying attention to that. As we look at the markets in the early days of 2026, we've seen a little bit of a rotation. I touched upon this. We're seeing more broader enthusiasm for stocks and for the economy, but we're seeing a little bit of a rotation early on away from technology towards things like healthcare, towards defense stocks. We're seeing Russell 2000 small caps perform really well. And so value is outperforming growth. And notably, EM is still continuing to outperform all geographic sectors on the hopes of higher underlying growth. And again, valuation expansion, because overall valuations continue to be more attractive as a lower starting point. So we're seeing some of that rotation, a lot of optimism around things like monetary policy. Here in the US, it is still slightly accommodative. Now, we did, of course, have 3 rate cuts last year. We're not expecting that again this year, but 1 to 2 cuts is certainly possible. If you look at the Fed futures market right now, nothing is expected in the first meeting in January, but following that in March up to June, we could see 1 to 2 cuts. Of course, it isn't always will be data dependent. Depends on what happens with the labor market. Will it continue to soften? Will we have softer GDP prints, softer overall growth numbers? That'll certainly support the case for more cuts. So the Fed, as always, will remain data dependent. And if you look at the dot plot, which actually shows where the FOMC participants anticipate rates going, they're pricing in 1 more rate cut next, or this year, I should say. So we'll certainly pay attention to that as it helps the markets out. Maybe more importantly, right now, as we're getting closer as we've turned the page onto 2026 fiscal policy, and because we expect that to be very accommodating here in this year, and that's because of the One Big Beautiful Bill Act, which could boost growth by some estimates up to 0.5 percentage point. The reason for that is because it is overall going to lock in a pro-growth tax policy for the foreseeable future, which again removes a level of uncertainty that was there before. it also is going to continue to incentivize businesses to invest in their invest in their business, do capital expenditures, and that tends to lead to productivity enhancement. And on the other side, the flip side, the lower effective tax rates for taxpayers means more money in your pockets, more money for households to pay on consumer goods. And so all of that lends itself to a happier consumer and more positive investor sentiment, which if you look at many measures, it is modestly positive. If you look at AAII investor sentiment, it's still above its long-term average. It has softened a little bit recently, which is kind of a good thing, right? You don't necessarily want to be at extreme levels. That can tend to be a little bit contrarian, as oftentimes that precludes a sell-off. But right now, it's kind of in that Goldilocks territory. And so we're looking at that. We're also looking at volatility, which is actually very, very low right now, which can suggest some level of complacency. We've seen this before as, volatility goes away, and it can often foreshadow unexpected bouts of volatility. So we will certainly pay attention to that as well. Last thing before we wrap up here, just want to touch upon the U.S. military action that captured Venezuelan President Nicolas Maduro recently. As we often talk about geopolitical events, even the ones that are very, very significant as this one, this is probably the most significant one in Latin America in several decades, tend not to move the markets that much, at least out of the gate. And so this instance is no different. We've seen some reaction, most notably in certain oil stocks. They've rallied a little bit. We've seen gold rally a little bit, and some defense stocks have done well in addition. But we're not seeing a major impact to the overall market. I think what's going to be more interesting on the longer run is what happens. Are we going to see political stability return to the region? Are we going to see the new leadership come in and boost the output of Venezuela? Because right now, productivity is actually extremely low, even though they have the world's largest reserves. So certainly all eyes will be on that. So like anything else, we will continue to monitor this and all the other factors that move the markets. We hope you found this today's updates insightful, as always. And if you have any questions about this and what's moving the markets today, tomorrow, or into the future, please reach out to us or your financial advisor. And we hope you have a great day and a great week. Take care.